It's nice to say, heading into the February reporting season, that the major banks have been able to increase the wealth in your clients' portfolios. The major banks have outperformed the market index over a 1 month and 3 month period, as per those charts there. Now, you might wonder where that value has actually come from, and it's safe to say it has certainly come from multiple expansion. We have not seen increases in expectations for earnings growth or for book value growth or improved ROE coming through in the banks. In fact, in the short term, we'd actually be expecting those items to decline. So very much multiple expansion driving that share price improvement. Key event dates for you just to look at there. So, the two statutory dates there are for CBA and for Judo. Judo have already pre-released. Westpac and NAB are expected to have trading updates coming through. ANZ hasn't officially said what they're going to be doing, but typically they would put out something akin to a trading update without the sort of P&L items within it. I think they may tie that in with the announcement, which is very much expected in February, of the Australian Competition Tribunal's decision on their view on the ANZ takeover of Suncorp Bank. That will trigger something in this sector. So if it goes through, very much it's obviously just an ANZ and Suncorp issue. If it doesn't go through, then you should expect that ANZ will actually trigger or announce a buyback. And if it does go through, I think it's probably game on for potential other consolidation within the sector with the regional banks. What am I thinking about in terms of just the very high level earnings drivers going into the reporting season? Well, first up, credit growth has been remarkably resilient. You should be sort of expecting sort of low to mid 4% type growth rates coming through from home loans in particular. In terms of what's going on with market shares, ANZ and Westpac have been aggressive. They've been growing market share. CBA, you might remember, they're the ones that actually led the withdrawal of the cashback offers. There's actually their short-term data showing their loan balances have actually been declining, and NAB's been relatively stable. The NIMs, you've heard me talk about how much of a driver they are of earnings. Expect that they will be declining, but the decline to be slowing compared to previous periods. Costs, inflation, they can't get away from it, certainly coming through wages, and also think about sort of vendor inflation also coming through. So expect that to be flat if their cost out programs are going very strong, if not increasing. And that's on an underlying basis. Typically, the banks will put through notable items. So CBA has yet to announce anything on that front. Just keep a watchful eye there. Credit quality, I'm expecting mild deterioration, but remember, that's coming off a very low base. So in actual fact, even if we do have some deterioration in, say, asset write-offs, I'm actually expecting a loan impairment charge going through to P&L to potentially be a source of upside to earnings over coming periods. And that's because those asset write-offs just aren't coming through as quickly as what the banks have actually provisioned for. Ultimately, this all comes through into a picture of declining earnings, declining ROE, and then thinking about dividends. In that context, I'm thinking about them being flattish. The one I should call out there, though, is remember ANZ put through a special dividend in the last half just to mitigate against the reduction in their franking. Don't expect that to actually come through again. And also be thinking about the capital positions. Still expect them to be strong. Obviously, 3 of the 4 majors have got their buybacks underway, and ANZ very well may pull the trigger on one if it doesn't get through with that ACT decision. So just wanted to comment on just the 2 banks that are actually reporting their statutory results. Now, it's kind of hard for me to say this because I know there's been a graveyard of analysts sort of saying this on CBA, but oh my gosh, these $115. This is on CBA's on 20 times PE. It's on a 2.6 times book. Its dividend yield is now nudging below 4%. It's around about sort of 3.9%. These are some really expensive prices. So I would consider trimming overweight positions if that's what you sort of think is the appropriate thing to do. I see it as being just so expensive. I'm at close to $90 in terms of target, and I know consensus is sort of floating around that same level. It's certainly a bellwether in terms of what's going on with the rest of the sector. So analysts, as well as the other banks, will be watching what CBA is going to be doing. So 3 things that I'll be looking for there. is just that trade-off that CBA has between that loan growth and margin. Obviously, it has tried to keep hold of margin as much as possible and lost out on a bit of loan growth, and also on risk. So in terms of just the credit quality that they're chasing. Second thing is the ability to mitigate that inflationary cost pressures coming through. And the third thing is just that credit risk profile that I was talking about with that potential upside coming through. So that's CBA. Also want to touch on Judo. Now, Judo is one that we haven't talked about a lot here, but Judo in the last couple of weeks has been hit hard by a negative analyst report, and then the following day put out an unaudited result and outlook that saw its share price absolutely fly up. And to me, it's a real potential, or it's an example of what could happen across the sector, I think, or across the market during reporting period when results and outlook statements come in better than feared. So is the share price performance done for this stock? No, I think it's got a lot more in it. And let me tell you the sell pitch here. So if Judo is able to hit its at-scale targets that it's got out there, so it would make it Australia's fastest growing, most efficient, most profitable bank. If it can hit those targets, and remember that Judo is a challenger bank and it's playing entirely in the SME lending space, so this is not without risk, but if it can hit those at-scale targets, then I think the stock's going to be worth around about $2.40. Now, that's not coming in the next year. This is a 3 to 5 year out type thing. But if it can hit 240, the stock is where it's trading at the moment, will deliver your clients a mid-teen IRR over that time. So the $2.40 comes through from two sources of value. So first up, it is not paying any dividends during the period where it's ramping up. However, I think its profit will grow very quickly. So I think it could double over the next 3 to 4 years in terms of profitability. So its book value per share should grow at high single to low double digit compound rates. The second thing is, if they can deliver their at scale targets, that should include an ROE in the low teens type level. If it's delivering that sort of return, that should be delivering a return above its cost of equity. That should mean that it trades on a price to book value about 1 or higher. So at the moment, it's trading on about 0.8. So you're getting multiple expansion overlaid with that book value growth, and that's how you get to that $2.40. So I think it's one to really look at for in terms of putting into your clients' portfolios in the small cap sort of part of the portfolio.
Thanks very much. So, just onto the insurance and diversified financial sector. Obviously, you would have seen that there has been some, bad weather in Queensland. I think the major thing to note, around Christmas, I think the major thing to note for IAG and Sun is they've still said at this stage they expect to sort of hit their guidance numbers for the full year. The insurers, the way they sort of stack up their protections against sort of events happening in Australia, they can generally handle a bad event. It's when they start seeing multiple bad weather periods that they, over the course of a year, that they'll tend to have to downgrade. So far, despite, I know a lot of people saw damage to houses in Queensland at the moment, they've broadly come out and said that they're on track for full year results at this stage. In regards to the health insurers, Medibank and NIB, still see these stocks as having a relatively favourable environment. Does still look like there's a slow recovery of people going back to hospital post-COVID-19, which is assisting their profits. There is some signs of increased utilisation in those areas, but at this stage, I'm still expecting both NIB and Medibank to deliver relatively favourable results. Probably the downside risk candidate for the DivFin space is Computershare. It's not a long-term downgrade issue. It's just that they're obviously very exposed to bond yields, and we have seen some pullback in bond yields since the start of the year occurring. Since the end of last year, which pushed their near-term risks at earnings. As I've said before in the past, Computershare generates or benefits from movements in the yield curves very, very quickly. The insurance companies, IAG, Sun, QBE, tend to benefit over a 2 to 3, 4 year period. So they'll benefit less quickly on the way up and less quickly on the way down, be impacted less quickly on the way down. So that's the way to think of it. In regards to upgrade candidates in my sector, I think probably Tyro's a standout to keep an eye on. The major reason for that is their numbers at their AGM in October if you annualise them, were ahead of guidance. So they were seeing very strong numbers at that period. Obviously, there's some risk to the discretionary consumer near term, which we don't avoid. But they were tracking ahead of guidance at this stage. Probably the stock that I think is really in the weight basket of my coverage is PEXA. I mean, PEXA's got a bit to prove up with their UK build out, and clearly the environment in Australia has been difficult. So I think that stock is going to struggle to move for a while, and there's probably better opportunities elsewhere. But I won't go into the detail too heavily on some of my areas. I'll just point out one thing. I'll just cover maybe some of the major points with our key picks and what to do after this meeting. Our key buy pick remains QBE. We continue to like this stock because it's got a very simple thesis. If they can double the earnings they did in the second half of 2013, in the full year this year of FY14, then the stock will deliver 30% EPS growth, and it'll be trading on 9 times earnings. We think that's way too cheap. I've mentioned before that QBE, and this is where the top right chart there is important. A lot of people call me about QBE interest rates and the impact they're having on QBE. QBE's new bonds that they were rolling into last year around November were about 4.9%, 5%. The yield they did on their fixed income securities reported in the first half of last year was 2.3%. So there's still a long way to go for the yield they've been making on their portfolio to get anywhere near towards the 4 to 5% that interest rate yield curves are currently delivering, even if you factor in that they've come off a bit. So they'll have a tailwind from interest rates into next year. You need to remember that whenever you think about this stock, it benefits from rising interest rates over a 2 to 3 year period. So the upside lift, the significant rise we've seen in interest rates that have come through over the last few years is still a positive tailwind for QBE and coming through, rather than it being a negative like it is for Computershare. The other stock we want to point out is Computershare. Look, it does have downside earnings risk, but I've maintained positive on this stock for more than a short-term view. Basically, Computershare has sold off some of its non-positive businesses or businesses that were losing money, and it is now focusing much more on the core businesses that have delivered very strong profit over time. Computershare at the end of this year, given the amount that interest rates have gone up and have benefited their earnings, they're going to have $2 billion of excess balance sheet capacity to make acquisitions. They've historically done very well making acquisitions, and that will be after they've done a $750 million buyback. So I just see this stock, which listed at under $100 million, which has become an $11 billion company, having a lot of firepower to go out and make accretive acquisitions, and having moved the business much more to higher returning, better value creation assets. And I just don't think at 13 or 14 times the potential upside for this stock is factored in. So I still like it even after the run it's had. It's not about interest rates. It's about what they can do with the balance sheet. And I do like the fact that the CEO of that business has gotten rid of mortgage servicing and things that were less higher returning, and has really focused the business on the core of what Computershare does, which is registry maintenance, corporate trust, and businesses where they generate over a 20% return on invested capital. So I think that mix shift that he's doing is probably yet to be fully factored into the share price for Computershare, and I think there's more upside from here. I mentioned Tyro, so I won't cover that, but I might just finish by I've got MA Financial there, which is one I like, but I might just pivot a bit to a couple I haven't touched on the presentation, but it's a couple I've been getting calls on, and I think are stuff you can action today. Where after the market has run, can you look at trimming some stocks in my section? Look, I think you can definitely take some profits on Suncorp. Suncorp at the moment is trading at 5-6 year highs. That's despite some pretty bad weather in Queensland. I'd mentioned that they haven't downgraded yet, but it does make the back half of their year more risky. I think this stock is historically very cyclical. Gets to high 14s, will then roll back down towards $10 or $12. So I just think there's an opportunity to take some profits here on this one. After it's had a good run, after the weather's been a little bit patchy. Yes, they might maybe execute the bank sale to ANZ, but there's risks involved in that too. But either way, I don't think the environment is good enough at the moment for this stock to be at a 5-year high, and I'd be taking some profits on Suncorp. In regards to Macquarie, I think the same. Macquarie is now getting sort of to $180, $190, $185, maybe moving towards $190. The stock had a massive miss at the first half result. It missed consensus by 20%. It didn't move down at all on the day. It subsequently rallied. We do know that obviously the share market's up, but the environment for investment banking and deals is still difficult at the moment. We're seeing it here at Morgan's. Yes, some of their energy businesses are benefiting from volatility, but that's come out a little bit as well. So I just feel the environment for them probably doesn't warrant them trading on close to 20 times this year. So I think it's an opportunity to take some on Macquarie as well. We do love that business long term. We mention its exposure to structural growth areas, but that doesn't mean I don't think you should trim some at some point. And I think Macquarie's at a level where I'd be selling some here, looking to buy back some towards a full year result where risks are probably maybe not to the downside given they've downgraded a bit, but certainly not to the upside. So I think they're my two primary trim candidates, both on valuation, both on the fact that they've run pretty strongly, where I don't think, there's upside risk to their earnings in the current environment. So they're my key sales picks, with Computershare and QBE being my key buy picks.
Thanks, Richard. I'll just round out with my coverage, which is primarily focused on the market-linked stocks, the platforms and the fund managers. As you can see, this basket of stocks has had a really strong run over the past 3 months, clearly benefiting from that market tailwind. So good to see generally some solid improvements there in our longer-term picks as well over the 1-year horizon, which has been GQG and HUB24. But I agree with a lot of Nathan's comments there. Although this sector does have earnings tailwinds from that market improvement, we have seen a lot of valuation re-ratings in these names, and it has pushed a lot of the higher quality names, in my view at least, into that fair value to sort of even maybe short-term overvalued in some cases. So reporting season, as we know, there are moments of truths. Again, Nathan mentioned it. I think when I look across my coverage, not only financials, but the rest of my coverage, I think that this reporting season for me, at least the stocks I look at, is a better than feared reporting season. So I think we're going to see at least the short-term movements on those stocks which are better than feared. I'm just going to make some comments on a couple of stocks really quickly. These two that I have up on the screen there are the results-specific call-outs that I've made in the larger document that we published. GQG Partners, look, it should be pretty simple, so the result shouldn't really matter. But I guess I'd put this on the more positive side in terms of the publication because of 3 simple reasons. Really, there is low downside earnings risk in this stock. It is a simple set of numbers. There is some marginal upside risk on top of that. And ultimately, the valuation remains reasonable to low, in my view, at this point. So before we get to the result, we're going to see a FUM update. We can track it month to month. The FUM is tracking higher this month again. The flows should be consistent with their recent performance, so net inflows. So I think the FUM update should be, marginally positive. And then again, to the result, a simple set of numbers. When I look across the things that can marginally underperform or outperform in a business like this, performance fees, it's not a performance fee model, but in their emerging markets fund, they outperformed over 6 months by 10% and over 12 months by 20%. That is an enormous outperformance. And keeping in mind, there is 30 billion in this strategy. So it's obviously not all or very little of it attracts performance fees, but there's marginal upside there. And operating leverage can come through better than analyst forecasts come through. So typically, when everything's going really well, we've got to be conscious that you don't overpay for fund managers and extrapolate that. They all go through their down periods, which we know this stock will be the same in time, but overlay everything going well with a reasonable to low PE of under 11 times. Still think that is a buy, despite what we've seen in terms of the share price outperformance over the last 3 months or so. And then Credit Corp, again, this is a better than feared one for me. One for the risk tolerant. I mention that every time I speak to the retail network. I know this is a volatile stock. It has rallied really hard into this result, but I think it can continue on. The headline result on my forecast will be up 34% on the PCP. So a lot better than I think the market is expecting in this name, given we saw a downgrade in October. That downgrade was premised on the back of their US performance. Our channel checks for the US industry suggest that things are improving, not deteriorating from that October point in time. So I think for this one, we will see a better than feared reaction. The stock's trading on 11.5 times next year's numbers. That's about a 30% discount to where we've seen it trade over the past. Just quickly on a couple of other stocks in my coverage. I won't dwell on these ones, not so much calls to action, but I think Pinnacle, for those that do own it, I think on a short-term basis, this share price run that it had, the result will struggle to justify that run. I think there's a little bit of downside risk on the composition in this result. The core earnings from their affiliates, so their stable of fund managers, ex-performance fees, is on my forecast down about 8.5% on the PCP. So given the run it's had, I don't think that really justifies the short-term run. Longer-term perspective is a different story. Plenty coming through 25, 26, but I think we'll get another chance. And on Magellan, I know it's still topical. It's been really volatile in a band. Look, the capital management prospect is certainly there, and the market does like that on the day. But for me, it's not enough to justify a buy into a declining core business. And I think there's going to be a meaningful outflow sometime in the next quarter when they convert that closed-end global fund into the open end. I think you'll see a pretty meaningful outflow on the back of that event. And just rounding out into the platform sector, I guess the colours here don't really represent a quality or long-term perspective on my views on this stock. The quality companies here are Netwealth and Hub, but extremely strong runs over the past few weeks is seeing both those valuations fall to potentially a bit overfull in the case of Netwealth. They've just had a FUM update out in the last half an hour, which I haven't a close look at. But I think, I've talked to Hub a lot, and it is my preferred pick over the two of the platform sector. Looking for another chance. I think the result might be the chance in the stock. They have had really strong cost growth in this half, and we'll see platform margins down again, and the market might take a little bit of short-term offence to that. So I'm hoping or looking for that result as a catalyst, but hopefully get that pullback, re-enter the stock. Sits in the model portfolio. Hatch and I speak about it. It is a very strong long-term growth story. So happy holding, but for non-owners looking for that opportunity. And just lastly, rounding out on Iris. Look, we've talked a bit about this one. The easy money in inverted commas has been made from this investment case, but I still think as we push through this calendar year, there is still upside to my valuation. This is not necessarily a reporting season view, but divestments will happen this year, and they're strong catalyst for the stock as we go through the months. Guidance was reaffirmed at the recent November update. We think there's more cost out. That'll be later in the year, and key will be stability in their core products. And there's nothing that we can see that would change the proof of that they gave in November, continuing it on. So. Not necessarily a reporting season, but at least on a 12-month view, I think Iris can continue on with its strong performance.